Good morning, everyone, and welcome to Today Mañana. I'm Alex. This is Xavier. We're really excited to have you joining us this morning. A happy New Year to everyone, and we hope that you're managing to stay safe and warm during what's a very cold.
What a way to start the year.
What a way to start the year here in snowy Charlottesville, Virginia.
I say let us get all the bad parts of the year out all at once.
First few days.
First few days, get everything wrong out all at once. The market's down. Everything, just get it all out.
By the way, who is that? Who is this talking?
This other voice that you hear is Nickolas Urpí. He's joining us today. I know, it says in the bottom in case.
He didn't even get a chance to introduce you yet.
I know, he just starts talking instantly.
I always just go right in.
You just cannot keep this man away from a microphone, obviously. The moment we put him on a seat, he starts talking.
I didn't talk in the little bit before the intro bit.
So this is Nickolas Urpí. He is the CMO of Emergent Financial Services. We're very happy to have you joining us today, Nickolas. I'm glad you could make it.
Thank you, Alex.
We're glad so far that he did make it. We'll see if we're glad at the end of the show that he could make it.
He has good insights, right?
He does.
Yeah.
He does. He has some good takes. And while he's
My
never
outsides are even better.
to put it this way, he's never shy about sharing his insights.
Never.
We'll put it that way. We'll put it that way. As always, just want to do a few thank yous. We are presented by Emergent Financial Services. We are powered by GBS Financial Services, by CVille Picnic, by Vitae Spirits, by Aqua CVille Hand Car Wash, and one of our newest sponsors by Craddock Serious Insurance, Miguel.
Miguel,
our friends,
that's right.
That they could come on board with Today Mañana and just support us. And of course, we're always proud to be with Adelante, the premier Latino networking group here in Charlottesville, Virginia.
And interesting, because GBS Financial, we're having him next week, which
we're going to have
talk
Johan
about
on
taxes,
next week. We're going to have.
It's not just winter, but it's also the beginning of tax season. And I know how much everybody just loves that.
Everyone's favorite time
Get
of year.
prepared to pay the IRS what they're due.
It's painful.
My favorite time of the year.
Exactly. So Johan is thankfully
after Christmas, of course. After Christmas.
You know, you love opening your gifts at Christmas, and then you say, "Let's see what my tax returns look like.
That's right, exactly.
Let's see how much I either owe to the IRS or how much I lent them in an interest-free loan."
That just doesn't happen anymore. When I was young, a couple times, I would do that.
Well,
but then I realized, wait a minute, what am I doing?
Some people purposefully overpay, and then are like, but I get the refund, just because they're so scared.
It's always my number one thing I tell people, like, a refund on April 15th. If the government is giving you back money on April 15th, it means that you gave them an interest-free loan the rest of the year. That's all I'm saying. They're just paying you back.
Listen, in the old days, when interest rates were somewhere in the teens, that was a lot of money.
Yeah,
today, since interest rates are so low, but still, the concept
the
of them having our
for
money,
you
that's
is
true.
still higher.
This way, if you delay in paying the IRS for a year, they charge you interest on that loan. They don't say just pay me back the same amount. I won't charge you anything extra.
We can talk about that next week.
We can talk about that next week when we have Johan on.
I have some.
So he's going to join us, and of course Stephanie Devada from CVille Picnic is going to join us next week.
Super. Okay.
The amazing things she's been doing. You would think. We know this, but obviously before I met Stephanie, you would think that you can't do picnics in the winter. You'd be like, picnic in Charlottesville, Virginia in January, not happening. But the pictures that you will see next week.
Picnic in the snow, is that what you're trying to say?
Picnicking that she pulls off. No, she puts them in on rooftop places. There was one that looked like it was on the top of, it's not Commonwealth anymore. It's the one.
Passiflora? Is that?
No.
Over here in downtown?
It's the club, the Common House.
Common House.
Common House. Okay. Instead of Commonwealth. Common House. She puts them on the roof there with a fire pit. She sets up the whole thing. There's some great pictures that you can see this.
Wow.
It's amazing what she manages to put together in any season. So CVille Picnic will join us next week as well. This week, of course, we are stuck with. We're really happy to be joined by. We're very happy to be joined by Nickolas Urpí. So Nick, how
Thank you, Jerry.
He gets some support.
Yeah, I have to say, Jerry's the only one who likes me.
To talk a little market recap.
I was going to say, don't ask me. Is that we were going to start with Xavier in the market recap.
I know Xavier has some instead of Christmas.
What's that?
Instead of Christmas trivia,
we have market trivia.
No, so it's not. I'm not going to test. This is not about a test. This is just about looking back, right? And what I found truly interesting, right? So we looked at 2020 and what happened in 2020, right? And then we look at 2021 and we see what happened in 2021. And just to kind of give you a feel, I mean, just the most simplest one, right? So the energy sector back in 2020 was down like 3%, right? And this year it's up about, let me see, well, I don't want to give anybody, but up 54%, right? Wow. And the interesting thing is, like, you know, we always talk about asset allocation, and sometimes people say, I'm not even sure what that means and how it works or whatever. But 2020 to 2021 is a perfect example why asset allocation works, right? And why it's so important, right? To rebalance, because the goal is, what am I looking at over the next, whatever it may be, whatever your goal is, 2 years, 5 years, 10 years, 30 years, right? Doesn't matter, whatever that goal is, you create a balanced portfolio that says, I want to get to Y, I'm at X, and I want to get to Y, and how do I get there? Mm-hmm. In other words, if you're expecting an annualized 5% return, 7% return, 10% return, how do I get there? What do I need to do to get there, right? So you create a structure, right, by investing in various funds that will hopefully get you there, right? Mm-hmm. But if you leave that alone, sometimes it's just, in other words, it's not the optimal. It's not that it's not that you won't get there, but it's not the optimal solution. It's that at some point
it will no longer be the structure that you put together. I mean, if you made a structure that's 50% stocks, 50% bonds, to be the simplest one, and stocks go up like gangbusters and bonds go down, at some point, your portfolio is going to look like it's 70% stocks, 30% bonds, and it won't be what you wanted anymore.
That's
because
correct.
You sat there and said, no, I wanted 50-50, and now it's 70-30, and it's a completely different portfolio. Because of the fact that, obviously, when something goes up, its market value, the percent of your portfolio that it is, increases.
But more importantly, right, so I'm going to give you, so these are, and again, I'm just giving you stats only because it kind of highlights what we're talking about, right? And so forget about bonds, right? Forget about the mixture of bonds and stocks. Bonds are gone. We'll talk about bonds later. But forget about bonds. So just in the equity markets, right? I mean, you have small cap, in other words, small companies. You have growth companies. You have value companies. Value companies are the large companies like Costco, right? Where they're already set there. They're strong companies. They pay out good dividends. So here's an example of what happened in 2020 just in those three areas, right? Because, again, when you look at stocks, you don't just put all your eggs in one basket. Mm-hmm. You don't buy all the small companies or all the growth companies or all the value companies. You diversify, again, for the reason that 2020 showed and 2021 also showed, is that you don't know exactly which sector is going to do well, right? So again, projecting forward, if you want a 10% return, of course, you're going to highlight more small companies, right? Growth companies. If you're looking for a 5% return because you want to be a little more conservative, you focus on the larger companies, right? So in 2020, the Russell 2000, which is small caps, was up 19.9%, so about 20%, right? The Russell 1000 value was up 2.7%. And the Russell growth, 1000 growth, was up 38.5%. Now, the Russell are indices that capture X number of companies. So the Russell 1000 is the 1,000 largest growth companies, stocks. Right? So 38.5%. Looked at 2021, the small caps are down 5% from the high. In other words, you would have lost 5% if you stayed on that, right? The value is up 22%, and the growth is down 11%. So again, think of it from the perspective, and not that the market's down 11, but from 2020, right, to 2021. So think about that. So if you had a portfolio of 10% in value, 33% in value, 33% in growth, and 33% in small, right? Yeah. And you kept that. At the end of 2020, the goal is, okay, let's rebalance and readjust, because obviously...
at the end of 2020, growth would have been a larger part of your portfolio.
Much larger.
Small would have been a much larger part of your portfolio, and value would look like a smaller part of your portfolio. It would no longer be 33, 33, 33. They would have, maybe 50, 40... in one type of growth, 40 in another, and 20 in value.
Correct.
So you sit there and say, well, now I need to
rebalance. So what you're doing is you're selling something that's gone high, right? Gone up very much. You got to
sell some of the growth and buy back some of the value.
And buy something that didn't do so well, right? And I think that's the whole point of the asset allocation. And it is amazing that 2020 to 2021 highlighted this more than any other time in history that I can remember. Granted, there's been time where emerging markets were up like 33% the next
There's
the
different
next
asset
year.
classes
Right.
that have done this.
But in the sense of in our own markets, it was astonishing what happened between 2020 and 2021. And-
Well,
and-
think of what you would have lost out on if you just left it alone. I mean, if you sit there and say, I never touch my portfolio, I'm not going to rebalance, I just leave it sitting there. Well, your 2021 return is going to look awful because you're going to have most of your
Well,
portfolio.
it's an opportunity because it wouldn't look
Opportunity
awful because
cost,
if all markets were up.
But it wouldn't look as good because most of your portfolio would be in the two sectors that didn't do as well in 2021, and the small part of your portfolio, the value, would be in the sector that did better in 2021. So by rebalancing and selling some of those some of the growth in the small and buying back some of the value, now suddenly your portfolio does much better in 2021 because you have more of the thing that ended up going up.
Exactly.
And less of the things that didn't rise as much.
Exactly. And so I'm just going to highlight a couple other things here because it's an amazing time, right? And of course we went into 2020, everything looked hunky-dory, then we had the pandemic, right? Government shut down across the globe, right? Technology stocks boomed. I mean, you look at Zoom and Peloton did enormously well last year, 2020,
they
right?
did well.
2021, right? Those stocks didn't do well at all, right? Because it was the opposite, right?
I think both of them returned to their pre-pandemic levels. So at this point, like you have to sit there and be like, did you take your gain? What was the purpose of you investing them in the first place? Because one of the things it was funny, we were talking with our uncle while we were in New York visiting family, and one of the things we talked about and we all agreed is that you have to have a purpose in investing before you start buying these things. Because if you bought Peloton just for the short-term gain, then you needed to get out while it's a short-term gain. But if you bought Peloton because you thought it was a good opportunity to buy, like one of the things we talked about is Peloton's argument, sort of like the problem it's trying to solve as a business is that people are not exercising, or Americans are not exercising because they have to drive to the gym and that takes time, and it takes time out of their day. So if you can solve that problem by making them work out at home. If you believe that is true, then you should invest in Peloton because they had a big push to get people equipment at home. If you believe that Americans don't work out because they just don't want to, and that it takes too much time out of the day, you wouldn't invest in that company because having an exercise machine will just gather dust.
You wouldn't invest in them long term.
Long term.
You would buy them at the beginning of 2020 saying, lockdown, and then sell them at the end of 2020.
In which case that's a speculation, right?
You wouldn't hold them for 3-4 years.
Yeah.
Because you're saying, I don't really believe this is a long-term bet.
Right. So,
then you're trying to time it, and that makes it much more difficult because now you're speculating on something like Peloton and Zoom rather than actually trying to be like, okay, I'm trying to invest in a company that is trying to do a certain thing.
But the beauty is, even from a long-term perspective, you take just the perspective of rebalancing, right? Let's say you said, you know what, I want to put 2% of my portfolio in beginning of 2020. You're saying, I'm going to put 2% of my portfolio in Peloton, 2% of my portfolio in Zoom. By the end of 2020, Peloton and Zoom are more than 2% of your portfolio.
Absolutely.
So then you have the decision to make. Do I rebalance? Do I go back to making them 2% again? And the way you do that is you have to sell some of them. And what would you do? You would lock in some of the gains, a portion of the gains that you got from them in 2020. So that's part of what the rebalancing does. But you need, like we always say, right? Buying a stock is easy. It's selling the stock that is the hardest part, right? You have to at some point have the discipline to say, I said this was going to be 2% of my portfolio. It's now 5 because it's gone up in value. I am going to sell some of it to bring it back to 2%. And that's the challenge of rebalancing, that you have to be disciplined and actually do it. You can't sit there and say, growth did really well last year. Maybe I'll just leave it higher this year and not touch it. So, you have to either believe in the strategy you set forth or you don't. And that's, I think, the behavioral challenge that comes into play.
Yeah, I remember a good friend of mine, Nolan. Remember guys, Nolan Horowitz, and he used to tell me that all the time. He says when you buy a stock, he says and it goes up. He says you feel good, and at times it's not that hard to sell it because it went up and you made money. It's when the stock starts going down that people just kind of fall in love with that particular stock. It's like well, it's already down 15%. I mean, at this point, why sell it? It's 15% cheaper than where I bought it. Then it's down another 10%. Well, it's 25%. Why would I sell it now? The issue is when stocks start going down, it's when it's the most difficult for people to sell, right? And it's why sometimes you have professionals, because professionals don't fall in love with stocks in the sense of your stock, right? Well, they shouldn't. Yeah, they really shouldn't. The concept is, when it's your choice, when it's your pick, and you buy something, it makes it so much more difficult to buy or to sell something, right? You know, like you said, buying is easy, selling is always the tough.
Selling is hard.
As a professional, you have metrics in your head. Is like, this is what I expect this company to do, right? And if it's not doing that at this point in time, you get out, because there's going to be other opportunities. And I think that's a concept that you have to have in your head all the time, is that there are opportunities all the time. It's not sometimes there's more opportunities than others, right? But you don't ever be in a situation where you say, well, there's nothing out there that I can buy. There's always something. There's always something that is opportunistic, right? Now, getting back to where I was, right? Only because, like I said, this is just, these stats are amazing, and it's not that we just look at these stats at the end of the year, but obviously at the end of the year, there's always the reporting, and you provide this kind of information, because we're always looking at this from a 12-month horizon every single month to see what's going on. But the Dow Jones REIT index, right, in 2021 was up 41%. And of course, we all know that real estate went through the roof this year, right? In 2020, it was down 4.79. Again, look at the divergence there, from down 4.79 to up 41.2%. What other one was really interesting? What I thought was, well, here's one where we know what happened here. That China, that's so funny.
We know what happened here.
Well, because I know what I'm going to say.
I know what you're going to say.
I know what I'm going to say.
Well, it's just funny because we know like you're going to allude to something but not actually say it. But go ahead.
So this basically is the Chinese index. So in 2020, it was up 38%. Last year, down 1.2%. And that doesn't capture every year, because it's only 300.
We know what happened there.
Yeah. So again, and MSCI, so the emerging markets, up 18% last year, down 3% this year.
No, you mean up 18 in 2020, down 3 in 2021.
Yeah, is that what it is?
20, yeah, use it this year.
Use the year, bro.
Yeah, it's just tough. 2020, yeah, Happy New Year. Feliz Año Nuevo. I forgot.
Feliz Año Nuevo.
So it just goes to show you, I mean, and I think the Russell mid-cap growth, that was a different one, right?
That's medium-sized companies.
Right. 2020, up 36%. Last year, up 12.7%. So again, the difference between, and the NASDAQ was up 45% in 2020, up 22%, right?
Yeah.
And the difference that we saw from 2020 to 2021, right, just because of the shift in what was happening in the economy, what was happening across the globe, is just unbelievable, right? And again, one never knows when these shifts are going to happen. One never knows exactly what's going to happen in the markets, right? But when you have markets like 2021, where you see huge discrepancies between, and again, in 2020, energy and real estate were just crushed, right?
Yeah.
When you see that, right, and you sit back, you go, okay, is energy ever going to come back? I mean, are we going to ever need oil again? I mean, at the end of 2020, you sit there, are we going to need oil next year? Most likely, right?
Yeah.
Exactly.
Is real estate done forever? Probably not, right? So you sit there, you go, these are opportunities. I mean, when the market's down that big, you say to yourself, there are opportunities. Do I sell everything, buy them? No. But you begin the shifting of, all right, listen, these particular funds did very well. This sector did very well, right? And yeah, technology is the future, but every once in a while, even technology takes a rest. And, we're seeing it even at the beginning of this year, right? So you shift, you begin to say, let me reallocate some of those funds into these sectors, just to make sure that I have a well-diversified portfolio. And by doing that is where you continue to have that growth in your portfolio that basically captures, more often than not, markets that, they got beat up on a particular year, and they may get beat up a second year. But over time, they come back, right?
But the key is that also that you're remaining invested this whole time. Because I think sometimes when you, because I think the notion of buy low, sell high, right? Buy low, sell high is one that I think people intuitively understand, but sometimes I think the implication is, oh, okay, I don't do anything. When I see that the price is really low, I buy it, and then when I see the price is high, I sell it all, right? What we're saying here is what you're changing is the percentage. In other words, you're always in, just as an example, right? You're
Exactly.
always in growth. So you have a portion of your portfolio. Let's say your target for growth is 20% of your portfolio is in growth stocks. You're always in growth stocks. It's not as though you wait to buy that 20% until you time it, like, oh, okay, it's low now I'll buy the 20%. And then when it goes up in a year, like, okay, I'm going to sell all my growth stocks and buy. By trying to do that, you're always going to be behind the curve, trying to pick who's going to win the next year and everything. The key is that you're always in growth. So let's say that it doesn't pan out, like we talked about. Okay, the rebalancing happened, but growth did great again. No problem.
That's right.
You were still in growth. You still
That's
had
right.
20% of your portfolio in growth. So that's the key, is that when you rebalance and you use asset allocation, you're always invested in everything. Is the key. You're never at a point in which you're saying, oh, I don't have any of that because I'm waiting for it to go low enough. You always are invested in something. What changes is the percent, the extent to which you are invested in it, because you're trying to always keep it in balance.
Exactly. And then just two more quick points on these things, and then we can kind of get into.
Well, we have an audience question.
Okay.
From Kevin. Did you want to finish these? For Kevin?
No.
We have
questions.
in our live
There you go.
audience having
Audience
questions.
There goes the neighborhood.
All right, I'll read Kevin Higgins, and then we'll do the audience one. So Kevin asked, what are your thoughts on significant Amazon investments into Go Green companies like Rivian and Clean Energy Fuels, which is renewable natural gas? Is this a glimpse into our investment future?
Oh no, there's no doubt. I mean, we've talked about clean energy, robotics, space, and we'll talk a little bit about that. And as a matter of fact, our quarterly focuses on some of that. But again, so these are areas that are extremely opportunistic and important. Starting in 2021, if you said, do you think clean energy is going to be important? You would have said, absolutely, clean energy. Mm-hmm. How did clean energy do last year? It was down, I think, like 15, 16%. So in other words, is it a good sector to be in? Yes. But your outlook has to be long in that, right? Because They are very small companies. It's a growth sector. So you got to say, I'm in this for the next 10 to 15 years, not I'm in this for a short period of time. Yeah. And you have to go in there. If the market's down 17% one year, say, time to put a little more, right? You got to buy. I mean, if you believe in clean energy, if you believe in the sector, you buy more. If you're a non-believer and don't think that that's going to work, then that's up to you, right? Yeah. But the point, if you believe that that's something that's going to, over time, do well, absolutely. I mean, I look at, I think it was the ETF I cleaned. Like I said, I don't remember exactly how much that was down, but it was down a lot compared to the rest of the market.
It was the opposite of the hot take, right? The hot take at the beginning of 2021 was clean energy is going to have a great year.
Well, sure,
That's right.
Because we expected with the
plus they had a great year in 2020.
Yes.
But you sit there and say it didn't, but that shouldn't change your long-term outlook.
Exactly. Yeah.
Well, because part of the thing is a lot of people in 2020, when we started to see all this like huge push for investment in green energy, one of the things was you see a lot of people like taking companies that they thought were going to be in 5 years going to expand and be able to take over the market or expand, and they were investing in them, but the problem is that 5 years, you can't expect 5 years of returns in 2 years, in the sense that these companies are still competing also with each other, which is another important point. Like, That's right. Amazon is investing in these companies, but if you look at like the fuel cell industry or the batteries, like there's no consensus right now as to which battery or which type of battery is going to be the clean energy battery of the future, right? I mean, Elon Musk was like, Plug Power was a big winner in 2020.
That's right.
But Elon Musk said Plug Power's batteries aren't going to be the way of the future. Who's right? We don't know, right? There's hydrogen. There's another company, Ballard Power, that they're going a different route that unfortunately slipped my mind right away. But everyone's got their own. How is it going to work? We were just talking to a gentleman, Alex and I, a couple of weeks ago, that was saying that there's an Israeli company that wants to make, in a sense, interchangeable batteries, such that like it's not that you go home and charge them, but you go to a battery station where your battery is taken and replaced. with an already charged battery. So it's
I got
just
you. So you can get going instead of sitting there at 4 to 8 hours.
yeah, it's
to
not a
recharge
matter
your
of you
vehicle.
going home and plugging in your battery. You don't have one battery that takes.
keeps
They're
swapping
charging batteries constantly, and then we'll take out your battery and replace it.
Gotcha.
So like almost like those stations at like the
like the way you
NASCAR
do that.
where you pop
As
out.
if that battery's up there.
Because the guys because that's how he described
Down
it.
there in the car.
The
Boom.
mechanic is looking up and replacing
Yeah,
the battery.
you're gonna drive
Wait a minute,
over
wait a
it.
minute.
You drive
Battery
over
gets
it,
pulled
you
out,
gotta-
bottles
You
it
gotta
out.
lift. You gotta lift the car to change the
No,
battery.
no, they're gonna have the guy underneath
You're driving
you.
over a hole in the
Oh,
ground.
It's like
and
the
you got-
NASCAR.
Oh, really?
It's
Is
like
that, is that
battery
the,
out that's the
That's
idea.
the theory.
Holy cow.
It's like
Okay.
like I'm trying to explain the NASCAR. You know how they
No,
drive into the
I'm
pit, they
familiar
take
with
off
that,
the wheels, and they put everything back on. They replace
Yeah, they
everything
don't have
out.
to
Within
jack up
seconds.
the car and everything.
Yeah, I mean, for Pete's sake,
okay, I didn't know.
they
I
might
didn't
as well
know
plug
that.
in.
See, I learned something new.
I was
love
trying.
this.
Every day.
That's why I was visualizing the guy
Well,
underneath.
I thought you
Because
look at-
the
look at-
battery's underneath, and you replace
I
it.
thought you had an inspiration from the good Lord. Which one is it?
God, which
Battery
one?
falls from the heavens.
To let me know so I can invest. But no, and so the whole point is that it's not just a matter of like, oh, I think green energy is going to be the future, because it's like, well, sure, we kind of suspect it will be, right? Because it's a better way forward, right?
Sure.
I mean, think about it. You're going to have a clean energy, and you're going to be able to, and a lot of people are going to be able to generate their own energy without relying on larger companies. So like, yes, everyone will want this, but how is it, what form will it take, and what kind, I mean, there's so much more in-depth science to it. You can't just say, well, green energy will be the future, in which case you could, there's different strategies into that, but there's also sub-strategies. Do you buy battery companies? Is that the way? Do you buy, the companies that make the metals that will be used? Because, I mean, those metals still have to be mined. You
Or do
can't
you
just
just
rely.
diversify? and buy the
Exactly.
whole
I was
thing?
just going to say, do you buy the
Well, right, but
company that does lithium, or do you just say, I'm going to buy
Right.
a diversified portfolio, and hopefully, there's enough of the winners in there, and it usually is, right?
Right, which is what I'm trying to say. It's not an easy call. You can't just be
Yeah.
like, yeah, green energy, I'm just going to go, like, how do you go into that? You can't just be like, well, Plug Power is a green energy stock, so I'm going to buy it. Because if it turns out, and we're not supporting either way, anyway, either for or against Plug Power, but just as an example. And if you pick them and you're like, this is going to be my green energy play, and it turns out that hydrogen fuel cells are not the future of green energy, you have entirely lost.
Exactly.
When
any
you were right
chance
on
you
the
had.
idea of green energy and
Yeah.
wrong on the execution. That's one of the keys of trading, right? Is when you purchasing stocks, right? There's two elements. There's the idea and the execution. How do you translate your idea into something that will profit you?
Exactly.
That will be profitable. And the execution is the way you do that. Because you should sit there and say, you just said it to be at the crash from 2020. All right, oil's too low. I want to get into oil. How do you execute that? In other words, you can't just go and buy
can't just-
barrels of
yeah.
oil and then
Can't just
resell
fill
them
up your
later
car.
on. You can't just say, oil's a negative price right now. I'm going to buy a bunch of oil, leave it in my house, and then sell it back later. It doesn't work that way. How do you translate the idea? And sometimes diversification is the way you do that. You have the idea, green energy is going to win. How do you execute? You execute through diversification. You say, I'm going to buy them all.
Right.
Because even though my return won't be as great as if I picked the winner, it won't be as terrible as if I picked the one loser. The last thing you want to happen, right, is that your idea is correct, but your execution is flawed such that you no longer profit on your
Exactly.
idea.
Well, I always like to
And-
use
and
the
the best-
eToys
listen.
Amazon example, because eToys was the hot stock way
Yeah.
back in the tech boom, right? Everyone thought it would convert.
eToys?
eToys,
I
yeah.
didn't even
Because
hear of it
they
before
thought
now.
that toys would go, they thought that they had a better shot of diversifying into other products than Amazon, which was a book company. But it turns out that Amazon found the way forward and ended up being the number one, I mean, somehow.
Maybe just the word toys just didn't quite do it.
No, it's just, I guess I don't think it was
No,
even
it's
that, it just, yeah.
Yeah. I mean, e-toys or Amazon. Amazon sounds like it.
Well, Amazon can do
I mean, how
anything,
many
I think
people
is the
thought
thing.
of original Amazon as a bookstore? I mean, what does Amazon have to do
It was a
with books?
bookstore, yeah.
I know.
Oh, Barnes and Noble doesn't
But
sound like a
what he's
bookstore
saying
either.
is
It's
the
like,
brand
it's
is
a
so
brand, it's a
flexible.
good point,
Yeah.
yeah.
The brand is
They're
so
more
flexible,
flexible.
it doesn't have to be books.
Yeah. Yeah. I was going to say, I mean, look at last year with Kathy Wood. I mean, she was kind of the genius in 2020, and last year she struggled. But I mean, not just her. I mean, obviously a lot of people struggled.
Well, listen,
And that's only
Druckenmiller
because that
struggled in
happens.
2020,
Yeah.
and Kathy Wood did great. So it depends. And part of
So,
the
I
thing
mean,
is it
it's
depends
just-
on what you're betting
Yeah,
on,
Exactly. But I mean, again, Kevin, I mean, I would say, yeah.
Kevin's
I mean,
got
it's-
another question too.
But first, I know we have a live
we have a
audience.
live
live question.
So hold on, Kevin.
This was for Alex, I'm sure.
What's our live question?
Yeah, sure.
Ask it out.
So I wrote this down and I was thinking about Xavier and Alex.
Okay.
And it's tied to the NASDAQ. So the NASDAQ plunged 3.3% on Wednesday on rising bond yields and Federal Reserve tightening concerns. The slide was its biggest one-day loss since February 2021. With yields rising, Alex, Xavier, and Nickolas, are you bullish on the NASDAQ? Would you invest your dry powder in a NASDAQ ETF like the Qs
Triple
today,
Qs.
right now? Like over at that desk over there. Answer this question.
The fact that you're still here means that you've lost the opportunity.
Yeah.
That came and went.
You know what? It's
Read that for the audience.
Yes, I'll read it again. So the NASDAQ is always fun to have a little in person. The NASDAQ plunged 3.3% on Wednesday on rising bond yields and Federal Reserve tightening concerns. So the slide was the biggest one-day loss since February 2021. And so with yields rising, are you bullish on the NASDAQ, which you literally don't know, and buy the NASDAQ ETF Triple Q that tracks the NASDAQ 100 index?
You know, it's interesting that you mentioned the NASDAQ, and I mean, the NASDAQ last year was a very interesting index because there were a lot of companies that didn't do very well in that index, and then there's a whole bunch of companies that did very well, you know, and actually we were actually talking with their uncle about that during our break. And I think it was, when you look at the NASDAQ, I think about 36% of its return comes from the FANG. In other words, those 5 stocks, you know, Facebook,
Amazon,
Netflix, Google,
Alphabet.
And Alphabet, yeah.
There's 2 A's. It's fine.
FANG,
FANG,
yeah,
yeah.
exactly, yeah. And it was, yeah, I mean, and at this point you can almost start adding Tesla because Tesla is basically huge,
It
right?
took up so much.
So when you add that, when you say to yourself, do I invest in NASDAQ, you have to recognize that those 6, 7 companies, including Amazon, are the biggest component of that index. So if you're bullish, at least you have to be somewhat bullish on those stocks, because if you're not bullish on those stocks, then you got to sit back and say, how do I invest in everything else that the NASDAQ has except for that? And I'm not promoting one way or the other, but it's something to think about, right? But the answer, Jerry, is, at least in my opinion, when you have an opportunity, when you have an index like that is down so large, so big, and again, it didn't do as well as some of the other indices last year, I think it's always an opportunity to say, yes, you know, I mean, the NASDAQ has those companies that are eventually the growth companies of the country, right? Mm-hmm. I mean, they have those, you know, those pearls in there, right? So it's probably not a bad idea to dabble. Do I say I'm going to buy everything that I need today into the NASDAQ? No, but I think they're buying opportunities.
One thing we've often talked about is the use of tranches.
Exactly.
So you sit there and say, okay, NASDAQ plummeted, right? The other day, down 3.3%. Good opportunity to buy. So, but you sit there and say, okay, I don't know if it's going to go straight up again or if it's going to have another down day. In other words, how big is this correction? You sit there and say, okay, I'm going to dollar cost average this. I'm going to buy 1/3 of my position. So I want to invest $1,000. I'm going to buy 1/3 of that today. I'm going to wait a couple weeks to buy another 1/3, wait a couple weeks to buy another 1/3. So that if it does decline again, I'm buying a second tranche at a lower piece. So you move quickly, but you don't necessarily put yourself in a position where you put the whole thing in today and now it goes down another 5 before it comes up again.
And the other question you have to ask yourself also is that you take a look at those 5, 6 stocks. I mean, their projected earnings are so large. You say to yourself, can they keep that up? Can they really keep that up? I mean, does it matter? Because let's face it. I mean, when they were 30 times earnings, you go, yeah, that's just huge. That's just not normal. And then they're 40, and then they're 50, then they're 60. Now they're what are they, like 70 or 80? And you go, holy cow. I mean, how is that possible, right? But sometimes things keep going up. So again, I hate to do this to anybody, but it's a decision you have to make and say, do I believe in those 6, 7 stocks? Do I think they're going up as much as they've gone in the past, or are they going to, slow
Amazon
down a little?
didn't necessarily have a super great year
Well,
last
no, they
year
didn't. They were only
either.
up like 2%.
Top holdings of Triple Q. 11% Apple, 10% Microsoft, 8% Amazon, 4.5% Tesla, 4% Google. Listen,
Twice,
4% Google Alphabet C shares.
Right.
3.8% Facebook, another 3.7% Google Alphabet A shares, and then 3.7% Nvidia.
And,
Something-
and NVIDIA, I mean, just took
Just
off
took
last
off
year,
last year.
right? So again.
So you're buying
it's-
those companies again
Yeah.
if you're buying,
Yeah.
QQQ. So it's,
Follow-up question.
Uh,
You own most of those stocks already. Would you go into the Qs? You're essentially buying them again. as
Exactly.
you said.
No, I'd
Exactly. No,
I'd find an alternative ETF that doesn't have
I
those.
think the NASDAQ is full of all sorts of different tech companies and tech stocks and different areas of that. So, I mean, like IBB is a NASDAQ,
NASDAQ
biotech
biotechnology
index.
index.
So if you're looking at like, okay, because that was down too. So if you're like, hey, you know what? I don't necessarily want to buy Amazon, Tesla, Apple, all these things again. You look at something like that and you're like, that's been down. Because the NASDAQ as a whole has been down. You're like, maybe I will take a portion of my portfolio and invest in biotech, or I'll take a portion and invest in, they have other
In
sub.
other words, just look at subsectors of NASDAQ.
Exactly.
And that's something we actually talk to people a lot about, because it's why it's important, particularly if you don't have a financial professional doing this, you have to do your research on the funds, because a lot of times people will come to us with portfolios, either that they or another financial advisor have created, but in the
Or
portfolio.
worse, the robo funds.
Or the robo funds in the portfolio will go through some of the funds in there and say, this fund, top holding, Microsoft, 5%. This fund, top holding, Microsoft, 5%. This fund, top holding, Microsoft. But before you know it, 5% of your entire portfolio is in Microsoft, because it's the top holding in 5 different funds
That's
that you
right.
own. And each fund claims to have a different purpose. But because they're all investing in Microsoft, you have no idea until you do that research. Oh my goodness, 5% of my entire portfolio is in Microsoft. Do I really want 5% of my whole portfolio to be in Microsoft?
Exactly. No,
And the
and-
answer may be yes, but if it's no, you have to know that. So definitely, I mean, if you're already invested in these companies, then the question becomes, do I really want to double down on them? Or do I begin to look for subsectors?
Exactly.
Funds that are investing in subsectors of the NASDAQ, maybe funds that are not market cap weighted, to say, okay, I can go in here, because anything that's market cap weighted,
Oh, it's going to have
right,
those.
whether it's the NASDAQ or the S&P 500, your top holdings are going to be Apple,
Wait.
Microsoft, Amazon.
Break the
Facebook,
market
and
cap
Google.
weighting just in case there's anybody on the feed that doesn't
So,
understand that real quick.
Good point. So
'Cause we got 2 more questions from Kevin, but
Okay, so market cap weighted. So when you have an index fund or any type of fund, there's 2 ways you can do it. You can say, as the person managing the fund, I'm going to buy the same percentage of every single stock. You could say, I'm going to pitch stocks. If I really like Amazon, I'm going to put 30% in Amazon and the rest and everything else. Or you can do what's very common in indexes. So that's the S&P 500, the Russell 1000, which is that they're market cap weighted, which means market cap is the price of the stock multiplied by all the shares of the stock that there are. It's how big the company is in the market. So if you think about it, if you're market cap weighted, that means that the bigger a company is, the more of that company you hold in your fund. So any market cap weighted index, if you think about it, so just as an example, Apple is a tech company, and it is also one of the biggest companies in the entire, probably
almost-
the,
it's gonna be-
the biggest company.
it's gonna be almost a
in
$4
the
trillion
US stock
company.
market, right? So any fund that is market cap weighted that does not specifically exclude tech or Apple, Apple is going to be the biggest part, the
Right.
biggest holding in that fund. So if you buy an S&P 500 index fund and you buy a NASDAQ top 100 market cap weighted fund, your top holding twice is going to be
Apple.
Apple, because it's going to go straight to the top of both of them, because they're market cap weighted. So you might have to find a sector of NASDAQ that doesn't either excludes Apple by definition, because it's not in tech, or it's in biotech only, or it's in healthcare only, or you'll have to find a fund that is not market cap weighted, which says, I don't care that Apple is the biggest one. Apple gets the same percentage in the portfolio as all the other stocks, which is rare. There are not too many funds out there anymore that are doing equal weighted. Most of them are market cap weighted at this point.
That's nice.
Thank you. So now
that's
we
why I
have
thought we have 2 more questions.
for Kevin.
So one is about the future of cryptocurrency, and the other is, if Apple, Amazon, and Tesla fall, what do you think the overall impact is to the markets? And I'll let Xavier, if you want to just take
Which one do you want to take, Xavier?
I don't know if you want to take the second one first, only because it's still going off what we've just been talking about. And then
Sure,
we
I'll
can,
take the second one first.
We'll
yeah.
jump into
then-
cryptos in a
And then we can
minute.
jump into cryptos, yes. So, Yeah, I don't think there's any doubt about, I mean, we just kind of made the point that those are such a large portion of so many different indices. And one of the things you also have to remember is that in all the mutual funds, all the ETFs, all the institutions that manage these type of funds also, the minute these particular securities start to go down, and any time people start pulling out of the market, guess what? They have to sell the most. They have to sell the top guys the most. So it just permeates that pain, right, by the fact that you have to sell those. So if those 5-6 stocks start, diving, the whole market's going to dive. I mean, there's no doubt about it. I mean, that doesn't mean that there will be stocks that go up. I mean, like I said, look at this year in the NASDAQ. You had, I think it was 85 were up and, 36 were down or 46 were down. I don't remember the right statistics. So that doesn't mean that there won't be stocks that go up. And we see that in the biotech sector, right? I mean, a particular company that has something that is of extreme use and it passes all the tests, that stock goes through the roof, and it doesn't matter if the market's down 20%, that thing's going up 100, 200%, right?
Exactly.
So yes, there will be stocks that still go up, but from a market perspective, those are the drivers right now of the market, whether we like it or not.
And I think one thing to keep in mind is that as much as they dominate, part of this also depends on the reason for their decline. If their decline is more broad spread, right, and the rest of the market isn't rising to compensate that, then they'll drag the whole index down. But if you think about it, I mean, we talked about the fact that what are they now, a quarter of the S&P 500 is those FANG stocks. That does still leave about 75% of the S&P 500 that is not them. So
right.
if you have a situation where it's unique to them, in other words, Amazon and Apple, their PEs ratios, so their price divided by their earnings is so crazy high that people are like, they can't make it, I'm going to sell some. If that's the reason they decline, but the rest of the economy is doing well and the rest of the companies in the S&P 500 go up, the S&P 500 will rise, because most of it is still not them. But the issue is, obviously, if there's a situation where they're all down and nothing else is rising in tandem to compensate, then they'll drag down the performance.
The problem is this contagion, and that's what I always say. I mean, the world's changed so much because of target date funds in particular. I mean, that's a huge elephant in the room, right? And one thing you have to remember is that all these indices, it doesn't work as easy as we think. In other words, if you're an active manager, you can sell Apple, you can sell Facebook, you can sell all those guys anytime you want. If you're an index manager, you cannot just sell those guys. You are now selling everything because you have to sell it in the same percentage. So if there's a huge sell, right, in the market, if somebody comes in and is like, oh yeah, I think those guys are going down, therefore I'm pulling out of the S&P 500. Guess what? Everything's going down. Because of the fact that as an S&P 500 index manager, I cannot just sell those stocks. I have to sell everything in a particular percent. So everything begins to go down. Again, there will be nuances, but again, that's market driven by most likely the institutionals, right? So the point is that it's difficult for the S&P 500 to really either go up or down without those guys participating, right? I mean, those guys are the big participators. Can it happen? Yes, but that will be a rare.
It's not impossible, but it would take everyone else going up in tandem.
That's right.
Essentially.
Yeah.
Nate, I'd love to hear your thoughts on the crypto.
On the crypto, yeah. I mean, we've had
my
many
thoughts.
discussions.
What do you think?
We've had many discussions about
what does the future of cryptocurrency look like to you?
The problem is, like, cryptocurrency in general, it's one of those areas where we have, I guess, conglomerated all of them, and we've created this idea that there are cryptocurrencies. And in reality, when you start diving into them, you realize that they are all different. Bitcoin was not originally meant to be a currency. Ethereum was meant to be some sort of like value traded app creation. So it helps to create apps, create wealth. Right. And then you have Dogecoin, which was a joke. I mean, Dogecoin was started as a joke.
All you have to do is type in Dogecoin and look at the picture of what's on this cryptocurrency, and you're like,
it's the quintessential Doge meme. So it's one of those things that, like, you're looking at it, and the questions for cryptocurrency are interesting, because one of the things is cryptocurrency will never be able to fully replace other currency as long as countries continue to tax in their own currency. As long as you have to pay your taxes in the United States with dollars, the cryptocurrency can never fully replace dollars because you always have to pay the government in dollars. So you'll have to convert
So
at some point.
you'll have to exchange it.
So at some point you have to exchange it. And it's different because part of the problem is because of the fact that not every country is fully, I guess, if you had complete full trade, right, free trade, and you could pay your tax dollars in any currency you wanted. There are different economists have had different theories about them. Ludwig von Mises always believed that there would only be one currency because everyone would eventually flood towards the strongest. We don't know if that's true because the conditions to make that happen have never happened before. So part of the problem is cryptocurrency is kind of like its own market. So it's in a way testing out theories of currency on its own. Is it going to be, is it a store of value? Is that what it is? So it depends on why people are buying it because you can speculate and be like, I think it's going to go up because it's going to be, Bitcoin is going to be worth more because if you assume, hey, rich people need to hide their money from government so that they don't pay taxes on it, so they're going to do it in Bitcoin for all eternity, then...
But if that's the case, but then again, if that's the case, does the average investor really want to be in that?
They may or they may not. It depends how much more rich people...
The average investor doesn't usually go into the... No, what I'm saying is that there are already underground economies.
Yeah.
Right, in which things are...
But you've never been able to buy them before.
Well, what I'm saying is goods are traded and sold, right? And you can, if you want, you can go find them and trade in those goods as an investment, but the average person would never do that because they prefer to keep their money in legitimate investments.
Well, the underground economy does work with cash too. I mean, the question is, are we going to eliminate cash, right? So the question I have, because I mean, from a, I think we know who we are. In other words, we look at investing from three perspectives. You've got income, you've got speculation, you've got gambling, right? Mm-hmm. And right now we still put the cryptocurrencies in the gambling position, right? Because you're taking a huge, huge risk.
It's a risk.
Right. A question that I have for you guys, and I know we've talked about it, so it's not a question out of left field, is in the old days, gold and silver and maybe some other of the commodities were hedges against inflation, right? It seems like that has dissipated, right? I mean, given that we had inflation of 6.8% last year,
what you would have expected.
Gold did not rise at the levels that we thought, right? I mean, you look at 2008, 2009, where everybody thought inflation was going to go through the roof because the Fed again was beginning to pump money into this economy, right? Their balance sheet began to grow, right? Gold went through the roof, and then we had no inflation back then, right? So here we are, we had inflation that I don't think anybody even saw coming, and gold stood still, but cryptocurrencies went through the roof. So is the cryptocurrency going to be the next hedge against inflation?
It could be. I mean, it depends on, again, what we're talking about is like, it depends on why people are buying it and why people are going into it. If it is just a hedge against inflation, then you would see that cryptocurrencies, if inflation tails off, is not going to do as well. But if it's a store of value for people, then it will continue to do better because more people may want to put a store of value into it. But it also depends on which cryptocurrency.
The question is, that would move.
We don't know which one's
consolidated. The question
consolidated.
is whether and if cryptocurrency will move from gambling to speculation.
Right.
What I mean by that is, gambling is literally the only reason I buy this, and the only reason this goes up is because I expect other people to buy it. Speculation means, at least to me, when I think of speculation,
well, two things.
There may be some
in the investment world, probably gambling is also because the what's that called, the ratio of winning to lose, right? I mean, the amount of money you put to win is small. You can win really big, right?
Of course. Yeah. But I'm just thinking in terms of like, the only thing that pushes up cryptocurrencies right now is the fact that you expect other people to buy them. There's no intrinsic value to it.
It depends on which one, right? I mean, it depends on which one, which is the part of the problem is that some are arguing that. So, for instance, Bitcoin doesn't have an underlying. People say that the underlying value is math. Well, math, if you can show me a material, physical math, I would like to see it. There's no such thing as a physical math. So it doesn't have an underlying value to it. Like everything works on math in the currency world. Ethereum, however, claims that it is an exchange. It basically what it does is it's somehow an exchange where different companies can develop apps or businesses using Ethereum. It's almost like I kind of compare it from what I understand to like a video game currency. Where like in the video games, there are currencies that people exchange to buy their little weapons and whatever they need to advance their things. It's kind of like buying a World of Warcraft currency because people exchange it.
Which may put it into a speculation category, because then you have something that is being used to facilitate goods and services and may have a long-term future, but you're still speculating because it provides to you neither income nor a future stream of income. And that's really the key, right? If you think about investing in a stock, when you invest in a company, you're either investing, there's two reasons, right? A, it provides you with a current stream of income, in other words, it's paying you a dividend, or B, it will provide you with a future stream of income. In other words, you buy a growth stock like Amazon, because at some point Amazon will make a bunch of money and pay it back to you as a shareholder, right? They're making something. The question you have to ask with something like cryptocurrencies is, are there any of them that at some point will be used sufficiently to justify their long-term holding, or am I only buying it because I think other people will buy it? And that's going to be the difference between a short-term philosophy and a long-term philosophy. If you're only buying it because you think other people are going to buy it, then you only want to keep doing it until you think other people will stop buying it.
You don't want to be the last guy.
You don't want to be the last guy holding the bag. Like,
Yeah.
oh yeah, someone else is going to buy this from me, and then it's like, uh-oh, no one's buying it from me. I'm the guy with the holding the bag.
Exactly.
Right, so that's the issue, and that's our concern right now, just with the fact that right now there's only a Bitcoin ETF.
Exactly.
If there were a cryptocurrency ETF with a basket of currencies, we'd be talking a different story.
Yes.
But the only average retail ETF bet, granted, you can shell out a bunch of money and buy an actual one of these cryptocurrencies on a Forex market, but the risks there are very different.
And the cost is very high.
Significantly higher, right? But the only option for the average investor in crypto right now is a Bitcoin bet, not a crypto bet. And so you need to think very carefully, is Bitcoin the one? Because it could be, again, it could be the idea is correct, cryptocurrency is the future, and the execution is wrong, Bitcoin is not the one.
Right.
The cryptocurrency of the future is one of numerous others, or it's 5 others, none of which is Bitcoin. So that's the issue that I think exists
right now. It's just so to answer your question, Kevin, it's unclear because we are not exactly. I don't think anyone really knows what the purpose of these cryptocurrencies is as of right now, and we will have to wait and see as that develops.
I think government reaction is a big question mark in all of this.
Well, India's already reacted.
India has reacted negatively. China has reacted negatively. So, I mean, you could get to a point where you have all these cryptocurrencies, and then a future government says, nope, they're all illegal.
Even that depends, because all you need is the right one. Because going into space, Luxembourg has declared that any space company headquartered in Luxembourg will not pay any taxes. And the reason why is because they want space-based or asteroid mining companies to be based in there, because they suspect that it will be worth trillions of dollars to have them there. And, obviously the growth from that will be huge. If those companies all of a sudden get funded by Bitcoin, and Luxembourg allows that because it doesn't really matter because they're not paying taxes, then you could see all of a sudden, like, it doesn't matter if China and India says no.
Is how governments will react.
Yeah. So it depends on which government, how will react, how people use the bit. Like, how is it going to get? How will these cryptocurrencies be used to convert into real? So you can say it's okay to have, because like the dollar, you can say, well, does it have an underlying value? It's the full faith and credit of the United States. It's at least something, because you can also convert it into something of value. If Bitcoin only exists in the the internet ether, and like you have to convert it back to dollars to literally do anything, then you have a problem. Right now, a lot of companies are accepting payments in Bitcoin. Microsoft, Tesla, all these companies accept Bitcoin payments. El Salvador is saying, but if they don't, if all of a sudden these companies are like, well, United States has banned it, like we can't pay our if Microsoft can't pay its taxes in Bitcoin, or isn't allowed to convert them back into dollars, it's going to be hard for them to be like, yeah, we're going to keep allowing payments in Bitcoin, because it's going to be a nightmare for them. As long as it's still convertible, you can see the argument, but if it gets outright banned, all these cryptocurrencies, the companies are going to drop them too, because they're not going to want to hold currency that isn't
converted
useful
into another currency.
So buying it because its underlying value is math will not work.
And the issue is, like, we sit here and say, oh, that would never happen, but it's happened before with gold.
Yes.
Like most people forget that in the 1930s, FDR did in fact pass a law which required the surrender of gold.
Correct.
So if you were trying to use gold as your inflation hedge in the 1930s, said, oh, no, just give me a bunch of gold because I'm worried about, I don't want to hold dollars. At some point, the U.S. government said, no, you can't do that. Come turn in your gold and we'll pay you this amount. So it wasn't outright confiscation. They paid you back, but the amount they paid you was probably worth less than you thought the gold was worth. So
Well, remember, there was the fact that you thought the gold was going to be valuable because dollars would be less.
exactly. So there is a
Kinda was
history, like
confiscation.
even in the United States, the government has at times said, no, we do not want a second currency floating around because we want you to hold dollars.
All they have to do is declare it counterfeit, and that's it.
And that's it.
Yeah.
So,
Well, the other thing what I was going to say, certainly from our perspective, when we create portfolios, crypto is not in our asset allocation at this point in time. And we discussed it, and
we've got
one
a
of the
very
major
hard
reasons,
eye on it.
Yeah, and one of the major reasons is for that. I mean, there's only one ETF right now, and it is Bitcoin, and we just don't feel comfortable, right? However, as a investor, in a sense of, and I know Alex, you talk about this all the time. And you may have 2, 3, 4% of your portfolio and says, I want to gamble. I want to do something different. I know I have this bundle here that it's targeted for either buying a car, a house, retirement, child's education, whatever it may be, right? Those are in somewhat more safer investments that are going to grow, that are recognizable. And you take a small portion of your portfolio and say, hey, I'm going to buy crypto, or I'm going to buy a particular small company that I think is going to do really well. It's the same concept. In other words, you are literally gambling in the sense that you're betting that it's going to work in your favor, right? You don't take your whole portfolio and do that. But again, at this point, using crypto as a hedge to inflation, we just don't feel comfortable.
It's questionable right now.
Yeah.
We did have one last question. If you wanted to go there, unless you had
Sure.
something.
No.
I'm going to combine. I'm going to slightly change up the question because I don't want to end on a totally negative one. So.
I didn't realize we ran out of time.
Kevin asks, what keeps you up at night thinking about the future of your clients' money and retirement? And I'm going to rephrase it slightly as a two-parter. What keeps you up at night? What are you worried about? And what are you excited about? For the future. So one
optimistic out.
Well, that's one a little
Right.
optimism in there too.
Yeah, it's funny, and we literally had a client yesterday, and she was saying how, she, if she had to do this, she wouldn't be able to sleep at night. And I said, well, this is why you hire us, so that we don't sleep at night, and you can, right? But the answer is, to be totally honest, there's nothing that doesn't allow me to sleep at night. And the only reason is because when we are managing assets for clients, right, they have goals, they have expectations, and they have risk tolerances. And once you understand what their needs are, what their tolerance is, and what they're expecting, right, you create a strategy that fits them. We understand that there's always the quote-unquote black swan event, right? But even then, a black swan event is only horrible if it happens right at the smack time where somebody says, okay, I need now 20, 30% of my money. Can I get it? It's like, yeah, you can get it, but boy, you just put a huge dent in your future cash flows, right? But other than that, nothing really keeps me awake because you work your little butt off, right, to create the strategy that fits every single client, right, that they're going to feel comfortable with, right? And as long as you communicate that, and we do that very well, I think, and continuously, as long as you communicate that, then you feel good. For us sleeping well at night, there's lots of other things that let me sleep, but it's not that. It's not the
What are you
market.
excited about? That was the second part.
What am I excited about? Boy.
Cryptocurrency, obviously.
No. It's funny, and it's what I said at the beginning. Life just changes every single day. It just has surprises every single day. And I honestly look at surprises from a positive point of view because sometimes there are challenges. And I think in life, when you have a challenge, I think that's good because you challenge, you take it on. And when you're successful at solving that challenge or helping somebody, it makes you feel good. So, what makes me feel good is just always looking forward and thinking that tomorrow is a brighter day for, as many people as possible. Yeah.
Absolutely. Nick, what about you?
What keeps me up at night?
Both.
Well, to be honest with you, one of the things we have to say is that we have a more especially with our business, a more stoic sense of looking at things in the sense of, like, there was a famous quote from Epictetus that if you can control it, change it. If you can't control it, don't worry about it, because you can't change it. So one of the things we always like, the history of financial markets has been, it's going up despite the fact that we've had depressions, world wars, everything. So we're not going to worry about even black swan events, because if we can manage it, we will manage it. Part of what we do is, like, you manage risk. And then you hope for, and with the reason we have these long time horizons is because we know things happen and you have to manage them. And so, I don't think that anything necessarily keeps us up at night or we worry about, because we have a way of communicating to our clients that you're in it for the long haul and, we're here to help. What I'm excited about is every single year something really good happens. The thing about the financial markets is that they're sort of like a very small glimpse, but they are a glimpse into the world's kind of capitalist motions. And we can see as problems arise, businesses also arise to solve those problems. And financial markets allow you to own and invest and help those companies accomplish that by giving them capital. So what I'm excited about is that whatever that next solution is, because sometimes people ask me sort of like, there'll be a problem in the world. And, I was having a discussion with some of, my fiance's friends, and they were like, well, how would you fix it? And I said, I don't know how to fix it, but there's a business out there that does. So that's why you invest.
There,
Somebody knows how to fix this problem. There's probably 5 guys with 5 different ideas, and they're all trying to do it right now that we just don't know about. And with the financial markets, once they go public, you can invest in those companies, and they have the capital now to expand and solve that problem. So what I'm excited about is that there are problems everywhere in the world, and there are businesses there that are going to be solving them.
Yeah, love it.
You too.
So, I agree. Obviously, I'll phrase it this way, from a financial planning perspective, inflation is what worries me the most, because that's one of the major factors for clients' long-term financial plans. However, from a market perspective, I agree. I think the key is that as financial advisors, we manage risk and we do not chase returns. And I think the chasing return is, I think, what causes people to be up at night, because you sit there and say, oh, I want to get 10%, I want to get 15%, I want to get that big winner. And you then, if you're only looking at that, you will take more and more risk, because as we all know, the only way to get more return is to take more risk. But when you sit there and say, here's the risk that I want for this client, and I'm going to manage in accord with this risk no matter what the market does, right? Then I always know that there's a consistency there. In other words, you will always do right when you do what you say you're going to do. So if you say, I'm going to manage it with this risk target, and you do that, then you're going to be fine. Because there's going to be days when the market is up 30%, and this risk target that you picked for the client, that portfolio is only up 15. But you can rest confident in saying, you know what, if that's the case, then when the market's down 30, I'm only going to be down 15. So you sit there and say, I don't feel as worried, because the key is we're managing risk, not chasing returns. If we were chasing returns, I'd be worried. But as you sit and say, how long can this go on? But it's not about that. It's about saying, here's the risk that you can afford to take, such that your financial plan will make sense. And that to me makes a lot of sense. And then in terms of what I'm excited about, kind of going back to what you said earlier, there's always, even when you look ahead and say, okay, maybe this isn't going to be a great year for certain ones, can Apple continue to do what it's been doing? Can some of these stuff, there's always another opportunity out there. So I'm kind of excited to see what opportunity arises this year that I haven't been thinking about before, because obviously last year was value, year before was tech growth. I'm curious, are we going to go back to tech growth this year? Are we going to see maybe emerging markets which haven't really popped in a while? Are we going to see, some other area of the market that hasn't really done well come to the fore this year? And so I'm excited to sort of see what that is, and to see, like you said, what people come up with. So I think it'll be, I'm looking forward. I think it'll be an exciting year. You have
it will be.
Look positively at it and say, okay, this is going to be an exciting year. We'll see what happens.
Yeah, I agree.
Great question, Kevin.
I agree
a great question.
with both of you. Yeah.
And we're going to do a little shout out because we have Rosalia de Rosalia Cordaro watching.
Oh,
Heather Word, and Elizabeth LaMarche.
Ah.
Thank you
Also-
all for watching.
Yeah,
this
some
one.
people
Thank you.
liked in the show today. Reina Laman, Lucrecia Morales,
Lucrecia.
and Quentin Bettram. Thanks for liking the show today.
Thank you so much. Yeah.
Yeah, Happy New
This
Year,
has
guys.
been this has
Happy
been
New
fun.
Year. It's
You
been
know,
a lot of fun.
I enjoyed this. Yeah.
Absolutely.
This is what every Monday's like at
Exactly.
Emergent
You got a
Financial
slight
Services.
glimpse into the
Yeah.
Emergent Financial
Obviously, we talk
Services
about other
conference.
things here and there, and
Although we do keep our tempers down on this show.
yeah, we certainly do. Yeah.
We're really not that. I think anyone who knows us knows we're really not that temperamental.
Oh,
Yeah,
no,
maybe.
Alex and I get it the most, actually. Ironically enough, you wouldn't guess it. By the way, we are on the show, but he and I are the ones that will have the most disagreement on stuff. And my dad will just sit there and be like, "Wait a second."
I'm gonna guess that.
Yeah.
Yeah, Dad comes in and says, "Here's the right answer."
That's right. You're both wrong.
Here's the right answer.
Well, that's the nice thing is that usually Alex and I are sort of like a barometer for different ideas, and then my father will just come down and be like, "Okay, let's compromise on this and find a way forward," and usually it works out.
There you go. That's where we have it. So just a happy New Year to everyone. We're really excited. So next week, another fantastic show.
Yeah.
We have in store. We're
Looking
gonna have
forward to
both,
that.
Both Johan Torres from GBS Financial Services. He's going to talk to us a little bit about what to think about for tax season, a little prep there as we start going into that season. And then Stephanie Devada from CVille Picnic is going to come and tell us a little bit about what she's been doing and the creations she's been putting together even in the midst of chillier weather.
Talk
You know,
about
especially as
talk about positive, right? Having a picnic
Exactly.
during winter. I mean, that's
That is a
great,
positive,
right?
yeah.
Exactly.
Yeah.
Just,
Fire pits.
positivity and ingenuity at work there. So we're going to have them both joining us on the show next week. So just definitely excited for us. We're really excited about our new partners. A bunch of new partners actually. We got Craddock Serious Insurance, we got Aqua CVille Hand Car Wash, and we love our partners of Vitae Spirits, CVille Picnic, GBS Financial Services, and Forward Adelante. As always, we're presented by Emergent Financial Services. You had a little bit of taste of the team here today
Taste
on the
of the
show.
team, yeah.
And as always, we are especially powered by you, our audience. We really appreciate
Yes,
you
thank you.
watching. We do again wish, I know there's a little more snow in the forecast tonight, so be sure to be safe and warm. We hope you're doing well, and we wish you a very happy New Year. Feliz Año Nuevo.
Feliz Año Nuevo.
No,
Yeah.
Próspero Año.
Próspero también, yeah.
Yeah.
Próspero
Próspero
Año
Año
Nuevo.
y felicidad.
Y felicidad.
This is Happy New Year. So until,
Sounds like a song.
I know, it sounds like a familiar
Yeah, I
song.
don't know, yeah.
You know, we'll have to look that up. Feliz
Or write one, right?
or write it. But as always, appreciate you watching. Be sure to like and share. Let us know. Thanks, Kevin, for all the questions
Yes,
today.
thank you.
Get them
Be
ready for
sure
next
to-
week. Yeah.
Be sure to send us any questions, comments, things you want us to talk about, and we'll definitely feature them on the show. We look forward to seeing you next week. But until then, hasta mañana.